Great. So today we're here to discuss, it's an advisory that we have called the VXX Trading System. VXX Trading System, and we've been in business since 1983, primarily focused on the high-end options analytics sphere. OptionVue is a software, provides options traders with the highest end analytics in terms of theoretical modeling. Now, our Discover Options has been our educational arm for about 10 years or now, and VXX has been around for a few years. We recently came out with, well, not recently, I mean, early last year we rolled out a revised set of rules after, you know, a couple of years of further research, and I think you're going to be very interested to see this. Take a look at this equity curve here. Let me click the down arrow. No, let's see here. How do we go down? There we go. Here's the equity curve since March of 16 when we went live with this, and this is consistent with the backtesting work we did going back to 09, and we've recently done even further work back. But this is March 6th of 2016 through July 24th, and these are the live signals that we were publishing. And so you have, and then of course this is all, you know, this is, I mean, we're an educational company, and we do not provide personalized financial advice. So we kick out these rules and we educate people as to the philosophy behind it and the indicators we give you and all that, and more on that later. But you have the system kicking out an annualized return, bottom right corner, of 168%. Just outstanding. The total return was 232 through July 24th. And you can draw down, you know, commencing starting in later in March of this year. And again, when you're gunning kind of returns, you're going to have some volatility. And I'll show you a chart going way back that shows that this is quite consistent. So what is the trading system itself? Now that we have, you know, we can see that the returns are outstanding, what is going on here? How do you do this? Well, here's the system. It was developed by Len Yates, our founder and president, and it's called Len Yates' VXX Trading System. It times the entry and exit for your capital to be placed as either long the VXX, that's the iPath S&P 500 VIX short-term futures exchange-traded note, or your capital would be in XIV, long the XIV, Velocity Shares Daily Inverse VIX, the short-term exchange-traded note. So these are exchange-traded products, and you know, if you're not in either of those, then the system has you in cash. Now, both of these exchange-traded products deal with the VIX, and so let's just review the VIX quickly. And so I'm not going to assume everyone understands the VIX, but let's just go take a look at a bar chart of the SPX. So before we get into the details of the system and what makes it hum and the philosophy behind it, we have to understand the VIX. And so here's a bar chart of the SPX. You have two lines under it. The red line, let's ignore that. That's the statistical volatility of the market itself. But take a look at the blue line. That reflects the volatility implied by the cash options on the S&P 500. So at the Chicago Board Options Exchange, they publish the SPX, and they have pretty much a corner on that. That's the deal. And they have a huge market of cash options on the SPX. And they've been rolling out for many years a figure called the VIX. It measures the volatility implied by the time premium in those options. Okay, and then they keep it intraday, open, high, low, and close. And that's what you see here is the blue line is reflecting the implied volatility, the 30-day implied volatility, which is the VIX. Now take a look at this, and hopefully you can see my mouse moving around. But just let's go to the far left, and you could see if the, you know, back in late July, okay, of 2014, you could see how the market broke downward, and at the same time, you could see the blue line, the VIX, went upward. Now, why is that? Well, there's a huge universe out there of portfolio managers managing billions of dollars of long assets, long equities of various forms and other. And when the market begins to break down, because their holdings are so large, they can't swing in those positions. They have to instead just hedge, and they'll partially or fully hedge their holdings at different times. Now, how do you do that? Well, one way is to go to the S&P 500 options market and purchase put options. They purchase put options, and as they do that, that drives the price of the options up, and the time premium will imply higher volatility levels in the future. That's how we gauge the cheapness or expensiveness of options. And so when the portfolio managers rush in to hedge, the VIX begins to climb. And I watch in early August, as the market recovered and went upward, the VIX began to decline. And so what you'll see is this inverse relationship here. And it makes sense, because when the market is in a bull market, it's less volatile. But that's in the discussion for a little bit. But I just want to show you this inverse relationship. Take again a look at September, how the market begins its sharp decline in 2014, and the VIX really begins to climb and goes from 10 to over 20. And then as the market rebounds in October, do you see how it comes down as the market goes up? So that inverse relationship is very important. It's very important. Now, let's take a look now at exactly what is going on in these exchange-traded products. Okay, if you're long the VXX, that's an exchange-traded product that manages, in other words, if you purchase shares of the VXX, it manages a long VIX futures position. Your money is being used in a fund, so to speak, and being managed by a manager who manages a long VIX futures position for you. Mind you, you do not trade the VIX futures yourself. Your money is being used to maintain a position that is long the VIX futures. Now, that takes me to the point here that what happened after years of having the VIX get published, the CBOE rolled out a futures market on the VIX itself. I'm going to back up there a little bit. And so like you can have a futures market on interest rates, you can have a futures market on the price of wheat, pretty much anything out there, you could create a futures market for it. And so they rolled out a futures market on the VIX, and what that allowed to happen was that when portfolio managers needed to hedge, okay, instead of just going to the S&P 500 put options and purchasing puts, they would also then go to the VIX futures market and go long the VIX futures as a way to hedge. Okay, and now this VIX futures market is very liquid. It is a very liquid market now. And so one way to take advantage of this or participate in the VIX futures, instead of going and trading futures yourself, you could just trade the VXX or the XIV. So the VXX manages a long VIX futures position. Okay, if you're in the XIV instead, your money is being used and managed as a short VIX futures position. And of course, if your money isn't either long the VXX or long the XIV, all right, your money is back into cash. It's back into cash. Now, before we go on and go into the philosophy behind how we go back and forth between those, full disclosure, we have an advisory that kicks out trade alerts and signals. We give you access to proprietary indicators. All of them I'm going to show you today and more. We'll give you monthly status emails. So more about that in a little bit. By the way, if you trade these items, VXX and XIV, know that these are very liquid. Okay, the average volume is just outstanding. VXX averages well over 80 million shares traded per day. The XIV is well over 30 million shares traded per day. All right. Here is the core backbone of the system. It's called the Yates VXX Indicator, YVI for short. We publish it internally within OptionVue. It is a 15-day weighted moving average of a component I'm going to show you in just a little bit. All right, and I have to take some time to explain that component for you to understand what's going on here. But basically, this indicator is one that once it crosses a certain threshold, the system goes long the XIV. Okay, and in this case, it was above that threshold for about 3.5 months before exiting into cash, waiting 2 weeks before going back long the XIV. It was long the XIV for about 4 months, exited to cash, went back above the XIV, and it was long the XIV for another 3-4 months. So clearly this is not a swing trading system. It's one where you hold position for weeks that turns into months. And there's a very good reason for that, and we're going to get to that in just a little bit here to exit into cash about 3.5, 4.5 months later. Let's now look at those signals transposed on an XIV price chart. Okay? I'm going to take a look at those signals here, transpose those onto an XIV price chart here. So now we have on the far left, you'll see on March 7th, the system went long the XIV at 21.18. It exited June 23rd at 30.05 for a gain of, 40, 45%, something like that. 2 weeks later, it went long on July 7th at 26.52. Exiting November 1st at 35.82, that was a gain of 33%. 2 weeks later, it went long on November 16th at 40.45, exiting on March 27th at 67.40 for a gain of well over 50%. So you can imagine if you were to get some profit on a 3.5 month trade, get out and then enter back in and take all of your previous profits and throw it into as many shares as you can. And if you did that continually, your money would begin to compound rather quickly if you fully reinvested every time you went from cash and then back into a position. And if you did that, we these numbers, and if you had $10,000 back in 2009 trading this system, 10,000 would be worth over $3 million today. And that's just the power of compounding like this. Just when you have 30% there, 40 and 50%, and you're fully reinvesting, you can have some incredible returns. Notice that there are periods here where the equity curve flatlines out and plateaus. And those are periods where the system is in cash. It's very important that you stay in cash when the system is telling us that. And there's a very good reason for that. So let's go into what makes this thing. Why does the VXX trading system work? Okay, there's one term to it. It's called the daily roll. The daily roll. Let me get a sip of coffee quick. I'm a high school football coach, and my voice is getting a little drained. Our first game is tonight, and we've been amped up here in practice, and it doesn't bode well for my voice in the morning for webinars. 1 second here. All right, the daily roll. To explain this, I need to show you a snapshot of VIX futures pricing, and this is an example from January, but I really want to go into the price structure here, okay, the price structure. And by the way, I'm some questions. I'm just looking at my screen, cruising through this. I'm going to go to the chat item and answer as many questions as I can at the very end, okay? But you can go ahead and type them in. I'm not really tracking questions during the middle of it, though. I'll just go to the end and look up and answer questions as best I can. So here are the VIX futures, and I really want you to study the price structure here. Jan is at 1220, is at 1925. We call this an upward term structure, upward. And this is what you would see typically in a bull market. Now think to yourself, which market is more volatile, a bull market or a bear market? You don't have to type it in, just answer to yourself. And if you've lived through bear markets like I have, and I know many of you have, you know that bear markets can be more volatile than bullish markets. In a bear market, the daily ranges can be really wide, the gaps can be quite distant, and in bull markets, typically the daily ranges are much narrower, the gaps are shorter, and you can have days that the daily ranges are just really, really tight, actually. And so when the market goes up, it typically chugs its way up. Occasionally, you'll have some crazy up days, but generally it chugs its way up. And when the market comes down, it typically comes down much more quickly than it goes up. And so that's what's reflected here. Because in a bull market, we know that in the next month or two, it's probably going to stay bullish. But you know what? The more distant out in time we go, the greater likelihood is that we'll have a bear market. And with bear market, we will have more market volatility. And so here you have that displayed. That expectation is displayed in the VIX futures. Now we're working our way to an understanding of the daily roll. So track with me here. If we were in a bear market, okay, indeed, these prices could be inverted with Jan having the 1925 and the SEP having the 1220. Now, why is that? That would be called a downward term structure. And that would be the case in a bear market, because in the bear market, if you live through it, all right, and you're still around, you know that those daily ranges can be crazy wide and the gaps can be quite distant. And in the next month or two, we know everyone's on pins and needles for the next month or two, right? But we all know there's almost a social contract, and it seems like we all know that in time, way out distant in time, eventually the bear market will end. Okay, the value buyers will come swarming in and snapping up the great values in the stock market then, and the market will then commence its long-term upward bullish bias that's been in existence for several decades. All right, as the stock market in whole, there's an upward bias. We all know that. And so, but that's the term structure. This is an upward one that you're seeing now. A downward one would occur in a bear market. Okay? Now, with that understood, let's give credit where credit is due. And I want to go to Larry McMillan, who rolled out this idea. He's a very famous options researcher and educator. He has a wonderful newsletter called The Option Strategist. And in February of 2012, he rolled out this idea. Then we get the newsletter every week here in our office, and we studied this. And Len Yates really teed off on this and developed indicators around this core idea. So let's just take Larry's words verbatim, because he does such a great job of elucidating this. So here we go. Both the VXX and the XIV are constructed in such a way that they actually own, like in the case of the VXX, or are short, as in the case of the XIV. Very important here. The two VIX nearest month futures. Each day, part of the position is rolled forward so that a constant 30-day forward position is simulated. Okay? When the term structure slopes upward, like what I just showed you, which it does most of the time because we're in a bull market more time, that daily roll is a debit and is a drag on the performance of the VXX vis-a-vis the VIX. However, since XIV is the opposite, it is a boon. It benefits the price of the XIV. Conversely, when the term structure of the VIX future slopes downward, the daily roll forward for the VXX instead is a credit, allowing it to outperform the VIX and consequently is a detriment to the XIV. Listen, I'm going to show you some examples here. Let me just show you an example of each of these. Let's go back to the term structure. And look on the left side of the screen, if you could. Up at the top, it says VXX. If you own shares of the VXX, your money is being used to maintain a long position in the front 2 months of the VIX futures. Now remember, your money has to be maintained. It has to maintain and simulate a 30-day forward position. So each day we have to peel off. In this case, you would be long Jan and Feb. Each we have to peel off a little bit of Jan and roll it into Feb to maintain that 30-day forward position. Now, if we're long the front 2 months and we're maintaining a long position, that means we have to peel off Jan and sell a bit of it and buy a little bit more of Feb. Look at the prices. If we did that, we are selling low at 12.20, buying high at 14.20. That is a debit that occurs, and that can have a measurable impact on the price of the VXX. Now, go to the right side of the screen, XIV. If your money is instead in the XIV, it is being used to maintain a short position in the front 2 months of the VIX futures. Okay, you're short some Jan and short some Feb. Every day we have to roll a little bit more into Feb by peeling off Jan, adding to Feb. That means that we're going to buy Jan back at 12.20 and roll it to Feb and sell it at 14.20. We are buying low and selling high. That's a credit, and that can actually benefit and measurably benefit. And we actually have an indicator that shows you what the benefit is, the price of the XIV. And that's the impact of the daily roll. Now, with that in mind, let's go back to McMillan as he tees off on this, okay? So the idea behind the trading system is simple enough. When the VIX futures slope upward steeply enough, like what I just showed you, that's a roaring bull market, and we want to own the XIV. That means we want to be short the VIX, because the daily roll is beneficial because VIX is expected to decline. Now, on the other hand, when the slope is downward, like in a bear market, we want to do the opposite. We want to own the VXX because the market is bearish. VIX is increasing and the daily roll is beneficial to the VXX. So, folks, here's what it is. It's kind of like we're just in a sailboat and we're waiting to see which direction the daily roll is going to benefit. Okay? When that daily roll benefits the VXX, we're going to open up the sail and just buy the VXX and hang on while the daily roll is benefiting it well enough. And then when that daily roll subsides and comes down, we're going to pull the sail in, go into cash, and we're going to wait to see which way the daily roll goes, what direction it eventually fires up in. If it fires up and is benefiting the XIV well enough, we're going to open up the sail, we're going to go long the XIV and ride that thing until the daily roll comes down again. All right? And so every good sailor has good navigational tools. So let me show you what we use to time the entry and exits into those two different assets. And so here's what we use. It's called the VIX Dip. It's something that we publish internal at OptionVue. We've devised and measured it. The VIX Dip is the difference in the prices of the front 2 months of the VIX futures. We take the second month minus the first month, and to come up with our VIX Dip figure. Now, the last column has to be positive because we can't have negative values for assets like stocks and everything. And so what we do is we take that second month minus the front month, and that's a value. And in OptionVue, we put that in the change column, and we add that to a base 0 of 10. If we have a downward price structure, okay, the value is going to be negative, and then we would take it away from 10. It would basically be added to 10. It would be like in the 8s or 9s. So if you have a VIX Dip in the 8s or 9s, something under 10, you know we have a downward price structure. If it's above 10, we have an upward price structure like what you see here. All right, so what we're doing now is measuring that, and we have gone back in time here at OptionVue. We've gone back in time many years and have recreated this value in terms of even intraday values, open, high, low, and close, going back, past 2009 now. We've done our back testing even back to 2004. And so we now have all this data, and we can now start really going to town and applying some indicators. And what we did is we start with the 15-day moving average, like what you see here. And we found that to be very effective, but after a few years of additional research, Len Yates came up with this idea of adjusting it for volatility. And when he did so, the signals and the back testing really, really worked much better. And so we now have basically an indicator now. And take a look at the lines. You have the simple moving average up above, and then down below you have the Yates VXX indicator that looks similar to the 15-day moving average above, but it has been adjusted for volatility. And by the way, the purple lines you see there, that's a discretionary indicator available to our subscribers. It's described in another video. It's called the danger indicator. But the Yates VXX indicator is a 15-day moving average of the VIX Dip, proprietarily adjusted for volatility. Okay? And basically what happens is when it crosses above 0.83, that's a signal to go long the VXX. When it crosses below, that's the little green dotted line there, it goes back into cash. And when it goes down below that red line there, that's negative 0.6. When it goes down below that, it enters into a VXX position. And when it comes above the red line threshold of negative 0.6, it goes into cash. So we have three different zones, so to speak. Above the green dotted line is we're long the XIV. When it's middle between the green and the red lines, it is in cash. And when it's below the red, it's in VXX. All right. Now, here's a little segment of time from 2011 where it went long the VXX for about 3-4 months. Let's go take a look at that time frame in a price chart of the VXX. And in that particular instance, it went long the VXX on August 5th, 2011 at 15.5, exited into cash November 18th at 23.44. That was a gain of about 50%. Okay, so once again, you have these amazing returns. There's one final point I want to make before going to any questions. And that is just to come back to this premise, the very premise of the system, is that we want to be in a position to take advantage of the strong daily roll. Okay, how big can that daily roll get? Let's go take an example and just take a look. Slice in time. This is from January 13th of this year. That's the same screenshot, the market when I've showed you before. On that day, here's an indicator we have. It's called the XIV Daily Roll Effect. It is that day's contribution to the price of the XIV from the daily roll itself. In this case, that day's daily roll was 36 cents. The price of the XIV was 55.23, which is 36 cents relative to 55.23. Let's go run the numbers. It works out to 0.65%, over 0.5% for that single day. At that pace, okay, for 30 calendar days for the month, at that pace, that's a 19.5% yield for that month alone. For that month alone. Now, is 36 cents, is that high? I'll tell you what, it is certainly not the highest. That is in the range that we want the daily roll to be for us to have a position. It's kind of in the low range of the middle to low part of the range that we want the daily roll to be for us to have a position in the XIV. It certainly is normal when we're in a position to have something around that. Might be kind of in the middle part or higher, but that's right in the meat of where we want to be here. So you can see again, if you're only in the VXX or the XIV when the daily roll is giving you the returns typical of this, day by day, week by week, turns into months of this kind of stuff going on, you can see how then, from 2009, you're only in the market when you're benefiting from the daily roll that you can have these kinds of amazing returns when you do the compounding that we discussed. And again, it's important when the daily roll is down and flat, you're not in the market. And know that you can have drawdowns like the equity curve shows. You don't get, over 100% returns without accepting a degree of volatility. All right, that's just the nature of trading. I think we mostly all know that. So where do you go from here? Okay, there's two things we have, and you could go to the VXXSystem.com website. We have an ebook that you can register for. Also, there's two more videos for you to watch. These are done by Len Yates, our founder and president, and really the developer of the system. He did a couple great videos showing why volatility persists, and as long as we have these instruments that are trading, why the opportunity is there. He uses great animations, and I'd encourage you to educate yourself further. If you want to participate in this kind of opportunity, you need to be educated, so when the volatile times come, you'll understand what's going on here. Also, we have an ebook that you can read, and if you'd like to learn that way, we would get that to you as well. But you would register and get this at VXXTradingSystem.com. You can also subscribe to our service. It's $1,200 a year, and with that you get email trade alerts and signals. We always kick out our trade alerts when those signals come. We give you at least a couple hours before the close that if you want to participate in those signals, you can go in and the trigger. Okay, we give you access to all the proprietary indicators and more through both the member section of our website and also within the OptionVue 8 software if you're an OptionVue subscriber. And also we have monthly status emails as well. At the end of every month we kick those out. Here is a snapshot of what it looks like within OptionVue and also at the member section of the site, real-time data on several different items related to the VXX trading system. You have the prices of the futures themselves, the data effect, the VIX Dip, and these all are updated in real time. And if you have any questions, you can always call our office and talk to one of the reps there at 847-816-6610. But at the end of the day, from here moving forward, these are the two things we'd encourage you to do, is to watch the videos and read the ebook. And we'd love for you to become a subscriber here. That'd be wonderful. Let me go to the chat and see if I can see any possible questions we've had. Okay. I don't see, oh, let me go to the questions. Let's click this. All right, let me see. All right, so there's some questions here. Let me come up here and see if we question. Okay. What was the largest drawdown? It's going to be, Craig, I believe it's in the 30s. It's in the 30s, I'm going to say. We did go back to 2004. I'd have to review that. That was just done here in the last week. And the reps have been throwing out an email with it going back to 2004. But you have drawdowns in, I would say it could get up into the 30s or so. But again, we're gunning for, and we had several years where we had well over 100% on this. Can I use the SVXY instead? With SVXY, I can sell puts and can generate the additional profit. This is from Marcus. Marcus, I think you can. However, I would say this. I have tried to take the signals here and employ it in the VXX options, and I've tried to use other option strategies around this, the system, and nothing beats the returns I can obtain just by trading the underlying and compounding it that way. It's a whole different dynamic when you go into the VXX or even those SVXY options, because now you have issues of implied volatility and skews and everything that's going on there. And I haven't been able to crack that, but at OptionVue we have a back trader that allows you to back test its content. And we have data going back to Jan of 2000. Okay, and we've saved option data going way back, and so you can even back test through 9/11 and all that. We have a wonderful back testing feature in OptionVue that enables you to do that. I haven't been able to crack that code yet in terms of an options strategy that beats the actual returns of just trading the underlying, but So it's definitely a temptation to keep trying. Why not use the TVIX and the TVIZ and be flat at the end of the day, limit your market exposure? James, that's a great question. I don't know the answer to that. I'm not familiar with those two products. I'm familiar with these and TVIX. I don't know what the liquidity is on those, but I can't answer that, James. I'm sorry. Call the office and talk to James, Jeff, or Karen. They might have a good answer for you there. Do you trade these systems live? These are all traded live. Well, now I'm gonna say yes, but it's a tough question because regulatory, you can't really represent that. So I'm going to say no, but you know what I mean. You can't. Let's just say yes and no. You can't represent that because then you expose yourself to all kinds of regulatory things. We are an educational firm and we provide personalized financial advice. Okay, just want to make that clear. On the chart that showed various exits back into cash, I noticed that there were several exits where there were some fairly substantial pullbacks before the exit. Do you all have any indicators that point to exiting sooner than not during pullbacks? You know what, Dwayne? When you go down that road, you begin lowering the profitability in the long run, okay? And when you develop any systems, you start to go after limiting those big deep pullbacks, you then reduce the overall profitability. And that's the give and take you have in any kind of systems building, right? If you want to get rid of the drawdowns, you shorten up the exit, but then you reduce those times when you can be in it and stay in and really get those and weather those storms and stay in and then take advantage of some longer run-ups in your profits. And so we did our best to calibrate the Yates, the YVI indicator and those thresholds of 0.83 and negative 0.6 so that those values are not over-optimized. Okay, we did our best so that it's not over-optimizing to the data back, and so that's kind of where we stand on that. We did those values make a lot of sense, but we don't do. We were very careful not to do the over-optimizing thing. 168 PC return PA. Okay, Alp, I'm not certain what you mean by that. Daily, the VIX Diff activity hinge on the activity of the premium, the difference between the S&P cash and futures. Does the VIX Diff activity hinge on the activity of the premium, the difference between the S&P cash and futures during the hours? I realize the VIX begins trading. Let's see here. The VIX Diff represents the difference in the price between the front 2 months. Okay, you're talking about the difference between the cash and the futures. I would speculate no. But again, you could call and ask Jim. I don't think so. I mean, the VIX Diff is not a measurement of that premium. All right, it's measuring the difference in the front 2 months. In what I showed you, Jan and Feb, Jim, and so the difference between the cash and the futures, you're measuring two different things there. So the VIX Diff again is a measurement simply of the prices of the front 2 futures months. Jerry, it's $1,200 for the year. 2 times bull and bear. James, not certain what that means. The monthly chart of the VXX is one huge downtrend. Do you ever sell calls? Interesting, Rick. That's exactly the system I have been working on and was working on, and the returns I got did not match the returns that one would get from just trading the system itself. Rick, theoretically, yes, you could go to the VXX options, sell call spreads, or just sell calls, and take advantage of it that way. But when you do that, as you'll see, when you go and start back testing that, and I've done that, I've done, you know, I've thrown in extra indicators and timing indicators as to when to sell those calls or call spreads, and but that's definitely something one can do, is that, and you ride that downtrend just by simply selling call spreads as it goes down. Absolutely. Okay. Awesome. All right. Okay. Thanks so much, everyone. I think my time is up. I really appreciate this, and look forward to seeing you over there. We'd love to do business with you. Please go to VXXTradingSystem.com, register for those items, okay, the videos and the ebook. Would love to have you aboard.